The markets exploded higher this week after the Federal Reserve did exactly what they said they were going to do. But can you smell that? It smells a lot like FOMO. Did you have too much cash on the sidelines and feel like you missed out on the rally? Before you FOMO, watch this video. So why exactly did the markets explode on Wednesday after the Federal Reserve raised the interest rates 0.25%, which was basically what the markets expected? It wasn't the rate hike, it was the press conference that followed the rate hike. Everyone thought that Federal Reserve Chairman Jerome Powell was going to come out hawkish, and although he didn't come out completely dovish, he actually presented a very even-handed view of the economy right now. As a result, the algorithms, traders, and investors all piled into the markets, which caused a huge FOMO rally into the end of the week until strong job labor reports showed that we were having a stronger economy than we thought, and the Federal Reserve may have to stay higher for longer. If you were one of those like me who was bearish and you kept a lot of cash on the sidelines and now you feel like you're missing out, you might be tempted to chase this. But instead of chasing it, let me show you a technique that I do that helps me figure out where to buy when a stock that I wanted to get into has taken off in a big way. For this, we're going to use a popular stock right now, SoFi Technologies, with the ticker symbol SOFI. As you can see, from its bottom to its recent high, it has increased 94.34%, so it can feel like you missed out on the opportunity to get into the stock. SoFi reported earnings this week, and that caused even more of a rally going into the week. And so now you might really feel like you missed out, but want to get in, you might want to buy right now. Don't do that. What I do in cases like this is to use Fibonacci retracement. And if you're in TradingView, you just hit Alt-F at the bottom of a move and draw it all the way up to the top of a move. And this gives key levels of support that SoFi might pull back to. If we extend this so that it goes all the way back to the beginning, you'll be able to see why this Fibonacci retracement method is so interesting. It turns out there are patterns in nature that also repeat themselves in the stock market. And you can see that in SoFi's past, it has regularly found support and resistance against the lines that this Fibonacci retracement has shown us. Typically, it's very common for a stock to pull back to the 50% mark of a move. This is halfway between the low of the move and the high of the move. And if you go back in time, you can see that there was a lot of support around these levels. So this might be a good place to start a position or even add to a position. If you're feeling more aggressive, you could always use a higher retracement line. If you're feeling more conservative, you can always use a lower retracement line. These can also provide targets for future buys. If you zoom out on the chart, you can see that it'll also offer us buying targets that it might find support at, even though these are lower than its all-time low. And that can be very useful too. You can use this technique with any investment or ETF. You just continue raising the higher point as it keeps going up, and that will give you possible levels that a stock might pull back to. Since there are no commissions anymore, you should also buy in stages. You have no idea how far off something might sell. So instead of going all in all at once, just buy in stages on the way down and plan your entire investment. If the stock stops going down and it finds support and goes higher, that's a high quality problem. You now have a profitable position. You can decide to add more on the way up, or you can just say what I have is what I have and let it go from there. So how's my feeling on the markets right now? I'm still bearish, but bull markets do climb a wall of worry, and you're starting to hear analysts say that the bottom is in and that this is the new bull market cycle. Personally, I'm neither bullish nor bearish. I always have a plan for the future. But let's take a look at the investments in play and see what the barometer tells us about what I think people are buying right now. Once again, you can see that the biggest positions in my portfolio are Apple and Nvidia, and that tells me that investors are taking on more risk. Rather than buying more conservative investments like Nike or Boeing, they're buying more risk assets. And you can also see that my new spec basket, it's a basket of very speculative positions, is now the 5th largest position in the entire portfolio. So that's telling you something. Over in the speculation in play portfolio, you can see that this week's winner is GrowGeneration with a 17.03% gain. The cannabis sector is always very interesting. It seems to move on rumors that the average investor like me don't get to hear. And a lot of the cannabis sector did go up this week. I don't know why. The next big catalyst in the space will be the legalization of cannabis, but for the moment, there's no talk of that on the horizon. This week's biggest loser is actually a new position this week, the U.S. Natural Gas Fund, with the ticker symbol UNG, and you can see it dropped 16.51% this week alone. The biggest winner in the speculation portfolio is also the most risky. Virgin Galactic, which is up 74.71% year to date. I only made one move in my speculation and play portfolio, and that was to actually open a new position. The U.S. Natural Gas Fund, with the ticker symbol UNG, which makes up the first of the class of 2023. One of the main reasons I opened this position was just looking at how far UNG had crashed since its high in August. It's dropped over 76.81%. As is always the case, I open a position very slowly, so I made my first buy on the 30th at $9.30 and then had a second buy filled at $9.25. I then made another buy on the 2nd at $8.43, followed by my last buy on February 3rd at $8.20. The combined buys gave me a cost basis of $8.80 per share, which represents an overall drop of 5.38% from where I initially opened the position at $9.30. And even though I made 4 different buys, I still only have a 27.93% allocation. UNG actually made new all-time lows this week, and this isn't a new fund. It's been around since 2007-2008, so that's significant. However, there are no promises that natural gas isn't done selling off. It could see new lows, so that's why I'm only in this with a 28% allocation. Personally, I think the sell-off in natural gas is far oversold. I think it's going to come back eventually because it is the transition fuel for the majority of the world. That being said, the reason I'm playing this with a fund and not using the futures is that the futures are time dated. You need the move to happen before they expire. This fund will just keep lasting, so this could be a very long-term investment, even though it is a speculative one. From here, my next buy target is $7.22, a price that I calculated using the Fibonacci method. And my next sell target is $11.02, just below a level of resistance that UNG sees repeatedly in the past. When we look at this week's winners and losers, you can see that the winner is SoFi, with a gain of 25.59%, after, like I said, it reported a blowout earnings quarter. The loser this week was Take-Two Interactive, with a loss of 4.4%. And this has to do with people thinking that people are stopping to play video games and instead choosing to have more activities outside rather than play games inside. Additionally, another sign that there might be too much froth in the market is looking at the year's biggest winner. It is Coinbase, which is up 110.88% this year. That's a month, and it's up over a double. Coinbase is going up with the price of Bitcoin, and Bitcoin is a risk-on asset too. So this is a sign that people are buying the riskier plays. I took profits in Coinbase this week, and that might sound a little weird to some viewers since my cost basis is much higher than where we are right now. And that's entirely because of what Coin has done in the past month and a couple of days. It's up over 175% from its bottom in 2022. Nothing moves that fast, and I needed to take profits. So I made a sale on the 3rd at $84.25, and this locked in over 106% in gains on shares that I bought a couple of months ago for $40.88. This did raise my cost basis 5.72% from $196.75 to $208. However, I needed to free up the capital and I needed to take those gains. That's a crazy jump, and I'd rather raise my cost basis than have it flip over, go all the way down and test its lows, and I missed the opportunity to capitalize. If Coinbase just keeps going higher from here, that's a high quality problem. Eventually it will hit my cost basis, but I do have plans to continue selling on its way up, with my next sell target at $125.20, a price calculated using the Fibonacci retracement method. And of course, I will add back into my Coinbase position if it sells off, but since I'm not super confident about it, I'm going to wait for it to get close to testing its all-time low. So my next buy target is at $31.90. Next up is Dow, and this might sound like I'm being a broken record because I've already sold it so many times this year. However, I am going to continue taking profits as long as it continues higher. And that's exactly what Dow did this week, so I made a sale on the 1st at $60.23. This reduced my per share cost 1.48% from $30.50 down to $30.05. And from here, my next sell target is $62.59, a point of past resistance. And once again, I'm still not going to buy Dow unless it breaks through its 2022 lows. This remains the biggest position with the most actual capital in it of the entire portfolio, so I won't add again until it gets down to $40.11. Dutch Bros continued rocketing higher this week, and it actually ended up hitting a point where I needed to sell and take profits. I had somebody leave a comment accusing me of always catching falling knives. Well, when you catch a falling knife, you're trying to buy your entire position at once. The difference between that and buying in stages is the matter of nuance. I'm not buying in all at once. I have bought Dutch Bros all the way down, but because I did that, my cost basis is much lower too. And that means I can now start taking profits on the way up. And I did so on the 30th with a sale at $38.20, which locked in 31.27% in gains on shares that I bought for $29.10 back on December 19th. And even though it only lowered my per share cost 0.42% from $36.10 to $35.95, I always believe in taking profits when you get that kind of a gain. From here, my next sell target is $45.70, below a past point of resistance for Dutch Bros, and my next buy target is $29.90. And as you can see, that's a bit off of Bros' lows. However, that doesn't matter. It's a key level of support from the past, and I do want to start replacing the shares that I sold if Dutch Bros sells off again. Next up is SoFi Technologies, and it's one of my newest positions. It was part of the class of 2022 at the very tail end of the year, where I opened it on November 22nd at $4.80. And as you can see, I've already sold it twice this year. Going into earnings, I had to take profits. One of my disciplines is when you're headed into a binary event and you have profits to take, you have to sell something. You don't have to sell that much, but gosh, take profits before a binary event. After earnings, SoFi really took off, and it hit my next sell target, which I had determined using past levels of resistance. So I had a sale that went through on the 2nd at $8.02. This sale locked in 87.38% in gains on shares that I bought on December 28th for just $4.28. That's a lot of gains in just over 1 month. And as I said, I don't take huge amounts of profits when I do, so it only ended up lowering my per share cost 5.36%, down from $4.65 to $4.40. I will continue taking profits if SoFi continues to rally, with my next sell target at $10.35, and I will definitely add all the shares that I've sold back into the position if it sells off to $4.26, slightly above SoFi's all-time low. Next up is Tesla. I opened my Tesla position in the middle of the pandemic sell-off back in March of 2020, with my first buy at $37.10. And even though I have taken all the capital out of the position and I intend to hold this for the long term, I still need to take profits when we see gains like we've seen. Just like some of the other stocks in this portfolio, Tesla has seen a huge run off of its lows, nearly doubling, with a gain of 95.46% off of its 2022 low. And even though I didn't buy near its bottom, I did buy in the 120s, so I had to take profits on February 1st with a sale that went through at $171.49 when we were heading into the Fed meeting. Whenever we're headed for a binary event, I always have to take profits if I have them, and in this case I had 40.77% in gains on shares that I bought for $121.82 just a little over a month ago on December 23rd. This sale lowered my per share cost $16.88 from negative $31.40 to negative $48.28. A negative per share cost means that I've taken all of the capital out of the position, in addition to $48.28 in profit per share of the shares that I still hold in the portfolio. At this point, since I am playing with the house's money, I am in no hurry to take profits until we see what the price action looks like. I always do have a profit target though, and this one is near its all-time high, with my next sell target at $412.96. Additionally, I will replace the shares that I sold this week if Tesla makes an attempt at its bottom, with a buy target of $101.85. Thank you for watching. Please hit like and subscribe, and I'll see you in the next video.